Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is the VideoCast episode 69, podcast episode 59. Time flies. We've got a lot to cover today. Thanks for joining. For those of you who listened in last week, you know we were down in Tampa for a swim meet for my daughters, which you can see there. That's Annabelle, my 6-year-old, and Mimi, my 8-year-old, and my wife so generously taking the photo. And we were down there for the swim meet, and I turned to my wife. I was like, this is bananas. We're going to watch the Super Bowl, the greatest game in history with Tom Brady, maybe his last ever, two of the greatest quarterbacks with Mahomes, 5 minutes away in a hotel room after this swim meet is crazy. So we went to the game. We had an absolute blast. It was so much fun. It was spread out with the way they had it. So it was just a nice time. Mimi wound up beating her club record, all-time record. The club's been in existence for almost 4 decades for 8 and under 25 butterfly. She won the 25 breast at the meet in Tampa. And Annabelle, the little 6-year-old, is now the fastest 6-year-old in the country for 50 freestyle. So it was certainly a worthwhile trip. Out of when life gives you lemons, Connecticut's still shut down. You make lemonade. We flew to Florida to get them some times booked while they were still 6 and 8. And turned out to be a great thing. Mimi is a huge Guy Fieri fan, so we went to 6 out of the 7 Guy Fieri restaurants in Tampa and St. Petersburg. Needless to say, I have been swimming laps like crazy this week to work that off, but it was unbelievable. I mean, these places were just great. Like smoked Texas hash, they like smoked the chicken. It's just amazing. Chipped beef, grilled octopus. She ate grilled octopus. And then on Monday, after all that, the game and the meats and all the food, we went to Busch Gardens and we went on this ride called the Cheetah Hunt, which my wife insisted, oh, no, this is an easy ride. Don't worry about it. We got on it. The poor 6-year-old was crying by the end. I was almost crying by the end, but it was fun. We got that out of the way, and then we went on the baby roller coasters for the rest of the afternoon and headed back. But that was just a lot of fun. And moving right along, that was before the swim meet in Tampa. Their swimming pool in St. Petersburg their aquatic facility is right on the beach. It was just beautiful. Again, turning lemons into lemonade and great time. On Tuesday, I was on the Clayman Countdown with Liz Clayman, the first day back, and the EA announced a deal to buy Glue Mobile for $2.4 billion cash. I said to Liz, look, it's an all-cash deal. Management didn't want to part with their stock despite it trading at 26 times earnings. If management didn't want to part with their stock, I'd probably be less inclined to part with their stock and may want to even hold it. $175 billion industry. Glue Mobile's got 14 million monthly mobile players. EA has 100 million, but Glue grew in Q4 at 25%. EA is only growing that part of their business at 3%. So Glue will help EA with the mobile. EA will help Glue with international exposure and distribution. Both beat on top and bottom line for Q4. And their peers, Take-Two is trading at 35 times earnings with flat earnings growth. They've got Grand Theft Auto. Activision Blizzard's trading at 28 times with 16% growth. They've got Call of Duty. And EA's got FIFA, which is the soccer game, trading at 26 times and could grow even more than all of them. Lowest multiple, potentially highest growth. That's what we like. That's what Liz liked. And then we talked about online betting at the end. And a quick teaser. So she was asking, are the stay-at-home stocks going to keep going? I've been talking about the rotation for 4 or 5 months on her show. It's been happening in spades. And I think we're going to see more of that as more and more vaccinations, the cases are rolling over. But I just laid it out. DraftKings is an online betting game. They flew in the stay-at-home period last year when everyone had stimulus money and wanted to gamble. Or expectations of gambling because the sports were shut down for a lot of the period. But bottom line, it's trading at $25 billion on $800 million of revenue. That is going to take an awfully long time to grow into, 30 times sales. Penn National Gaming is trading through the roof, 69 times 2021 earnings. their growth story is Barstool, but they only own 36% of Barstool. So, that's limited. I said the clever way to play it would be to buy Fox Corporation. So Fox News and Fox Business had record ratings in 2020. They re-signed Suzanne Scott to a multi-year deal. She's the CEO of Fox Corp. And she'll continue to bring strong programming, strong ratings will be back, and advertisers are going to be tearing back to throw money at them as businesses reopen and they want to capture the global pent-up demand. So it's trading at 13.5 times earnings. And why is it related to online betting? Because they have something called Fox Bet, which you basically get for free. They've got Tubi, which is an online streaming service that could grow quite a bit for the millennials and for the Gen Zs, and $5 billion of cash on the balance sheet to do buybacks and to do acquisitions. So rather than pay 69 times earnings on Penn or 30 times sales on DraftKings, why not buy a good quality business that's growing for 13.5 times and get the online betting for free? And we left it at that. So that's thanks to Liz and Jackie D'Ambrosi Scales for having me on Tuesday. This was Larry Menti. This guy's got so many Emmys I can't even count, and always love going on with him. He asked me to come on to his show Jersey Matters on New Jersey News Network. I always love to come on because I'm a Jersey boy at heart. I grew up in Park Ridge in Bergen County, New Jersey, so anytime I can do anything Jersey related, happy to do it. And he wanted to get a good explanation of what happened with GameStop on the way up, on the way down, ramifications going forward, etc. This is really a comprehensive, great interview because Larry always asks the best questions. If you really want to understand it backward and forward, how it happened, why it happened, can it happen again, what should we do to put in guardrails, etc. If you haven't gotten enough of the GameStop saga, this is about 8 or 9 minutes. Definitely check that out. Thanks to Larry Menti and his producer for putting me on. And next is I want to thank Devik Jain and Meta Singh for putting me in their Reuters article on the 9th. I guess that was Tuesday. We now have my quote was, "We now have a situation where the Democrats do not need Republican approval in order to move ahead with the $1.9 trillion stimulus package." Market was trading up. She was asking why. Also, they asked me the same day, Elon Musk had bought $1.5 billion of Bitcoin for Tesla's balance sheet, and my quote was, "If any lesser mortals had made the decision to put part of their balance sheet in Bitcoin, I don't think it would have been taken seriously. But when the richest man in the world does it, everyone has to take a second look." So that it is what it is. I mean, that's seriously a big development for the Bitcoin followers. So we'll keep an eye on that. And then today, Herbert Lash had me in his article on Reuters. Thanks to Herbert. And by the way, for the Bitcoin comment, I want to thank Subrat Patnaik, Anna Herrera, and David Randall, and Devik Jain again. Devik and Meta had me in their article as well. Meta Singh, thank you for having me in your article and that article. And then Herbert Lash today. The point I made was value and cyclicals outperforming in a rising rate, higher growth environment, which the U.S. economy is on the cusp of entering. Said Thomas Hayes, "We're underestimating the lagged effect of all the money in the system as more and more vaccinations are delivered and as more of the company reopens. We are continuing this rotation that would be consistent with the new business cycle, and as bond yields go up, value and cyclicals will lead." So that's been happening. We've been talking about that for months. It's been happening in spades, and certainly the case today. Even when the market was down midday, banks were up, 10-year yields were up, etc. Moving on to our Ask Me Anything question, comes in from Ben again. Thank you for your question. Two good questions. What's a good entry point on a pullback regarding XOP? That's the ETF for exploration and production. I've been pounding the table on this since before the election. So, 40 was a great entry point. Now it's at 75. It's up almost 100%. This is tough because, over the next 3 to 5 years, energy is going to continue to go up. Why? Because the new administration policies are taking supply down. OPEC has the cuts till April of next year. Demand is going to rip roar back. So, when you miss things like this, the best thing you can do is buy over time. So, if you bought a little here, if you're lucky, you'll get a pullback to the 50-day, $58 to $60. That would be a gift from God, and you should back up the truck. But if you don't, just buy, spread it out over 10 buys over the next 10 weeks. Maybe you'll get some at 75, some at 70, some at 71, some at 65, some at 60. And your average will be 68, and 3 years out it'll be at 125 or 150 or maybe even more. I mean, if you look at this, effectively the proposals that are in place, just to get back to 2018 levels, never mind the peak in 2014, you're talking about $160. So what are we at, 70? So you want to wait for it to go back to 60. What if it goes up to 100 while you're waiting? I wouldn't get too cute. I'd think long term on this, and maybe go under the surface and find some companies that are high quality that have lagged a bit. But this trade is working. The other question he asked, which is a good one, and I'll get to it. Okay. All right. I'll get to it right now. As you mentioned last Friday, Apple is a good tell for the direction of the markets. Please explain why. So I went into this a little bit last week, and the point was that there was such a massive degrossing on the GameStop thing and the highly shorted stocks, hedge funds getting squeezed. They all degrossed. They went to cash. Once that happened, then they capitulated. The market ripped right back up after a 3.7% correction. That's the good news. The bad news is I'm not of the opinion that degrossing, which was the largest since 2009, over a decade, that quickly gets resolved in 24 hours. And my sense is that there are enough of them that got smashed, and we saw the articles in Barron's about some funds being down 25% in January, that they're going to get redemptions. And when you get redemptions, where do you create the liquidity? In the most liquid performers. You sell your winners to pay for your losers. And what are the biggest winners? Is FANG. So over the years, and with Apple being amongst the heaviest weights, and it was interesting because Apple traded up huge into earnings. You can see here from 126 to 144, and it's traded down ever since. Perfect earnings. Buy the rumor, sell the news, but it just hasn't recovered, even though the market's been strong. And that tells me that there's some selling going on to meet redemptions, and it's probably going to continue. So the theme that I want to cover, that I talked about with Herbert over at Reuters, and thanks Herb for putting me in your article today, is to look for rallies under the surface. So while FANG has been relatively flat since August and cyclicals have outperformed, we could see a similar type of situation. If these redemptions are happening, FANG is going to be disproportionately hit. Apple is what I'm keeping my eye on. And you can still see monster rallies under the surface. Like today, when the market was weak, banks were very, very strong. 10-year yield got up to 120 basis points. So keep your eye on Apple. I mean, if Apple makes new highs, then everything's off to the races. But if Apple stays subdued here, this rotation is showing you that it's persisting, and I definitely keep my eyes on that moving forward. So good points that you brought up. I can see that you're totally on top of everything and paying attention, Ben, and we're highly appreciative of that, and grateful for your listenership and viewership. Moving right along to our October 15th, 2020 article, I'm an Accountant Stock Market. You can find every single article we've ever done on the website under categories. You can click on commentary, or you can click on sentiment is our weekly article. You can also listen to our podcast under VideoCast Weekly Recap, or under podcast is the other category. Long story short, October 15, 2020, these were the two key charts that I want to cover today. The first one was this XLE chart, okay? And we were pitching the rotation into energy. Cyclical rotation that began in September and paused in October is set to resume in Q4. Banks and energy will participate and lead. So that was the thesis. I put out this chart of XLE. It was trading at $30.52 that day. Okay, so where is it today? It's at $45, so it's up exactly 50% in the last basically 3.5 months. And this gives you a longer term perspective of how much further we have to go to normalize. And now that supply is getting taken offline, that drilling's going to be cut back on federal lands, the pipeline's knocked down, tens of thousands of jobs are going to be exported from Texas and the Midwest to Saudi Arabia and to Iran. And within 2 to 3 years, mark my words, and everyone thinks this is bananas, but you know what? When I was saying on the podcast a year ago, when oil was at $30 and $35, that we would be at $60, $70, $80 over the next 1 to 3 years, we're already at 60, and it's been 6 months. So when I'm telling you these new policies are going to cause us to have to import from the Middle East and return power to OPEC, where they can then name their price and jam us at $80 and $90 again, like we saw just over a decade ago with similar policies, that's going to happen, and you want to participate, but you don't want to participate with the marginal producers that are going to be bankrupt from all the lost jobs. You want to participate with the largest players that are going to get bigger as the price goes up, and all of the destroyed competition is going to accrue to them, not only to the Middle East, but to the big U.S. companies like your Exxons, like your Chevrons, like your Conocos, etc., that make up the XLE. Just Google XLE top holdings, and you'll find the top 10 beneficiaries of the new policy as oil continues to move up. Now at 60, over the next 2 to 3 years, will be at 70, 75, 80. And then when OPEC has firm control, maybe even more. Although they probably learned once they get up to 90 or 100, they destroy the economy and then they lose the customer. So probably, the 70 to 85 range will be their sweet spot, and they will mint money and regain a lot of power that Russia, Iran, and Saudis lost with depressed oil prices when we had a strong energy policy. They were weakened geopolitically, and we experienced a period of relative geopolitical calm and peace as they regain the profitability, the money, and the power. I think that dynamic will change, and they will play a much bigger role on the global geopolitical stage as they did 10 years ago. So keep your eyes out for that. So the trade's working. That's all we care about on this. Leave the politics aside. Who cares? We're on this call to make money. Tom Lee put this out. Energy stock could surge 42% as oil prices extend 1-year high. So you're going to see a lot more of this. Opinion follows trend. Tom Lee is usually ahead of the curve on a lot of this as well. Certainly was on the general market. I don't know if he was on energy back when we were hammering it, but he's just someone totally worth listening to. Follow him on Twitter. So he says energy sector has a 42% upside potential as it plays catch up to the ongoing surge in oil prices. In his latest note on Tuesday, correlation of oil prices and the energy sector suggests that the Spider ETF XLE should trade at 63. So where are we at? 45 now, up to 63. Yeah, I mean, that's, I'm more patient. I see that in 1 to 2 years, maybe it comes, but I saw the $60 in 1 to 3 years. It came in 6 months. So, I'm always happy when it does better than, set expectations low and exceed them has always been a formula for success. So, anyway, so there's FOMO, there's obviously all these companies, as we talked about last week, we're going to just start to change. Here's an article, change their narrative so that institutions who missed the first 50% move in the sector can start to reinvest because they're missing their benchmarks. As the weight goes up and up for the sector, they're going to have to get exposure. The only way they can get exposure is if they justify it. The only way they can justify it is if these big companies come out with a narrative that they're going to be carbon neutral by 2050, and they're all doing that. We went through that last week. 5 of them put out their carbon neutral plans. Exxon put out their here's the headline from Jinju Lee's article in the Wall Street Journal. All the cool kids are doing carbon capture. Exxon's the latest in the game. And what's going to happen is they're going to get the ESG stamp because they're on board with being carbon neutral in the next 30 decades or whatever it is, and then all the institutional money can flow back in to the last men standing, and that will be a great opportunity. And the weighting will move up from 2% to 4% to 6%, and then everyone will have to be involved after they're up 100%, and maybe get as high as 8%. It's been double digits historically. I don't know if we'll get back to that, but something to keep in mind. Next, okay, this was today in Barron's. Demand for diesel is speeding ahead. What that says about the economic recovery. Diesel demand has returned to pre-pandemic levels already. Recovery for gasoline and jet fuel consumption has been less impressive, highlighting the challenges ahead to the transportation fuel sector as well as the economy. This is core to our back half thesis with defense and aerospace subsector, which can be played through an ITF like ITA or XAR, or if you want leverage, DFEN. We own that, but you have to be very careful. There has some leverage, embedded leverage. It's not appropriate for everyone. But defense and aerospace is, at these levels, in my view, is the best value per dollar to put new money to work, because a lot of this stuff is already moved. Like Ben is asking about XOP and XLE. We were talking about them for the last 4 months. They're up 50 and 100, 50 and 75, and some of the stocks in them are up 100% since we've been talking about them. So, buying them today is less attractive than buying them then. But I'm telling you, in my opinion, do your own work. I'm not a financial. I only deal with accredited investors and qualified institutions. See terms on hedgefundtips.com right here. But this is my opinion is that defense and aerospace are the greatest value right now, and at similar levels. This is the long-term ITA, defense and aerospace ETF. Similar levels to where you could have bought energy and banks 4 or 5 months ago before they took off. I think that when you look at some of the big names like Northrop Grumman, Raytheon, General Dynamics, Boeing is in there, playing a second half commercial aviation recovery like Greg Hayes was talking about on the Raytheon earnings call last week, is the way to go. So, okay, so diesel serves as a strong economic indicator for economic health because it fuels the movement of goods. So looking at those statistics along with gasoline and jet fuel demand, which represents passenger travel, provides insights into short-term consumer sentiment, says Jenny Zander, COO, Strategic Transportation Solution Provider Breakthrough. Diesel prices have returned to levels last seen in early March of last year. Robust through freight transportation and is ahead of year-ago levels. So U.S. demand has remained robust through freight transportation is ahead of year ago. So that means goods are moving like crazy, and that is a leading indicator for the rest of the economy. Okay. EIA data also show that the average amount of U.S. distillate fuel products supplied over the 4-week period through February 5th, which includes diesel as a proxy demand, was up 1.9% from the same period a year ago. That was before the pandemic. The pandemic talk didn't even start till late February, early March. Domestic gasoline demand, however, is down 10%, while jet fuel consumption has declined by 34% year over year. And that's, again, going to lag more vaccines. That's going to pick back up. As vaccine distribution ramps up, we expect to see an increase in gasoline demand, slow return to more typical travel behaviors, et cetera, et cetera, et cetera. So that's a positive thing and a leading indicator to look at, and it's good to see that already at pre-pandemic. Now, second thing, Holman Jenkins. Apparently, by the way, he lives in Ridgefield, Connecticut, so I'm going to meet him through a friend. He's an author in the Wall Street Journal. He put out a great article this week called EVs are the lowest climate priority. And the basis of this, and I didn't even know this, no matter how you slice the data, the car in your driveway is an emissions asterisk. And what does that mean exactly? If the EPA is right, the average light vehicle racks up 11,500 miles a year and sits idle 96% of the time. The World Resources Institute says passenger vehicles account for 7.5% of all emissions, but this includes buses, taxis, etc. Rental cars average 31,000 miles. Other fleet vehicles average 23,000 miles. Heavy trucks average 63,000 miles. And one finding that the appalled fleet operators is that their vehicles spend up to 33% of their time idling. The IEA estimated that if 50% of all new cars were electric, petroleum use would continue to grow because of trucks, aviation, and the petrochemical industry, which, by the way, makes up pretty much everything from football cleats to solvents to cleaning agents to plastic computers to most of the parts of an electric car, etc. So, if you take away oil, the cost of your electric car goes up like 3x, by the way, just for the parts, unless you're going to make it out of metal or tin or something like that. Trucks and aviation and the petrochemical industry, and we don't have major alternative to oil products there. ExxonMobil estimated more recently that if all new cars, 100% of new cars were electric by 2025, not 2035 like GE's pointing to, 2025, the world's entire fleet were electric by 2040. 100% of everything was electric by 2040. Liquid fuel demand in 2040 would be the same as 2013. So if this went perfect, 100% of every single car was electric, the demand would still be at 2013 levels, which is, by the way, was before the peak of energy when prices were really high. And demand, we've had no major investment in the last 5 years. So, if you had 100% of every car in the entire world electric tomorrow, demand, based on where supply is going to come in over the next couple of years, would still exceed, and you'd still have prices going up. And we're not going to have 100% of every car electric by 2025 or 2035 or even 2040, probably potentially by 2050. So it just kind of lays the backdrop for the pessimism on, the rumors of my death have been greatly exaggerated as far as the oil industry. Sure, the marginal players are toast, but the bigger players are going to get bigger than ever. So this is a really worthwhile article. And this is not an anti-climate change article. He's really just making the case that, focus on those areas first that contribute the greatest emissions, put all the money there, and then move on to this stuff later on in the process. Okay, Trivago earnings offer hints of when and how travel will return. Trivago is a big online website that does, it's like Expedia or Priceline, etc. And they're basically tying it to, so what they're saying is vaccines coupled with good weather should make a sound difference. The articles today were we are going to have pretty much anyone who wants a vaccine is going to be able to get one by April. We're going to have a glut of vaccines by the summer, which means, and the pent-up demand with all the stimulus money, with all the savings, we're going to see travel go through the roof and demand for fuel go bananas second half. That's why I love the defense and aerospace based on current levels. I love banks. I love energy. The problem is I own a ton of them at much lower prices. So do I think they're going up from here? Of course. Otherwise, I would have sold them. However, defense and aerospace, this I want to add. This is like still amazing levels, and particularly if you dig on, certainly the ETF, but if you dig under the hood and buy some of these names that are really lethargic, Lockheed Martin, Northrop, Raytheon, General Dynamics, Boeing, the big players, you'll look at them and you'll say, this, Wall Street is the only place in the world when it holds a sale, no one shows up. I can't re-emphasize that enough. I feel like I'm telling the exact same story that I was pitching about, Wells Fargo when it was in the low 20s, ExxonMobil, and these things have just ripped. So that's the greatest value per dollar, in my view, right now for new money. So, okay, Trivago's outlook for the recovery bodes well on online travel agencies' performance post first quarter, in our view. Booking Holdings is another, etc. And they basically tied it to like those periods before we had the spikes, like when the cases went down and it looked like we were getting vaccines, their travel business ripped up, and the same thing is going to happen, and it's going to be probably sooner than they think. It'll probably be by the end of Q1, everyone will start booking because cases are falling off a cliff. Because again, as I've been saying the last 3 weeks, when you take down one side of the equation, you've got 30 million people now that have basically had it. You got 30 million people now that have been vaccinated. So you got 60 million people. So now there's only, 270 or two, and then there's a ton of people that have antibodies that don't even know it. So you probably have like 250 million, or call it 230 million hosts, whereas a few months ago you had 330 million hosts in the United States. So it's just going to continue to collapse like GameStop. The chart looks exactly the same as GameStop. So that's good news. And then these guys, HFIR, I've mentioned them before. They do articles on Seeking Alpha. They're really good on energy and natural gas. They're always bullish, but they had a great article about natural gas storage draws ahead and what that means going forward. They estimate that the next two EIA natural gas storage reports are going to drop by 575 BCF, and we'll finish the withdrawal season at 1.4 TCF. The deficits. So effectively what they're saying is that the futures curve is dramatically underpriced for the deficits and the draws that are going to happen in natural gas in the coming weeks. And their view is that you should see 330 to 350 coming down the pike, and the forward curve is looking at 260. So it's dramatically mispriced as you look out a year, as you look out 2 years. And these guys have been spot on with their storage, and their thesis is to own the natural gas producers. They own EQT and Antero. But there's a basket. We've talked about them in recent weeks. We've owned Range Resources and a couple. But, this is all in line, to Ben's question. That's, there's some in the exploration and production. The whole complex, energy, natural gas, is going up over the next 3 to 5 years. Yes, it's already up 50, and some names are up 75 and 100% from when we started talking about them. But, on pullbacks, find those names that are still values, because, Marco Kovacevic out of Morgan Stanley, he's a great quant guy. I'm slandering his name here, unfortunately, but you know who he is. He's on CNBC from time to time. He says we've just entered the fifth commodity supercycle. I've been talking about that since the summer on CNBC Indonesia, that we're entering a commodity supercycle, and now it's upon us, and based on some of the policies, it's going to be exacerbated, and so you got to be in it to win it. It's coming. Take advantage. And then opinion follows trend. Occidental Petroleum, left for dead like a redheaded stepchild, was added to B of A's U.S. #1 list. Price target raised to $31. You couldn't give this thing away at $10. Now everyone wants it at $22, and they say it's worth. So it'll be up 200%. There are long dated warrants you can get on this. Anyway, it's just. It's exciting to see these things play out. That's all I can say, and participate. So I think the next great move, in addition to banks and energy over the next couple of years, is defense and aerospace from these levels is exciting from my standpoint. Okay, Tom Lee pinpoints, second article by Tom Lee this week. He's prolific today. Single most important indicator, signaling strong economic growth. And that is what we've been talking about for 6 months, which is the steepening yield curve. Instead, Tom Lee says investors should turn their focus to the steepening yield curve, which suggests that strong economic growth and subsequent stock strength is imminent. And that is that. So let's take a look at it. From when we put it out, this was like the first time we had put it out when financials had crashed. We said, okay, we had the inversion already. It's starting to steepen. We want to get exposure. Well, look what's happened. It's the steepest level it's been since 2011 now, the 210 spread, if you look at it as of this week. Wow, this thing is rocket. And look what happened to financials right after that. Boom, double or triple over the next few years from 2011 to 2018. So now you get a second bite at the apple. We're off to the races. Very exciting for banks. Pulling up, the second most important chart that I put out in that October 15th article, if you remember, was not just the XLE chart at $30.52, which is now at 45. Second most important one was the Wells Fargo. Here, the long-term chart, it was trading at $23.25. I said, guys, look, this is taking a while. It was consolidating like crazy. We're adding all through here. Just bananas. Our total basis this is the biggest position in all of our portfolios at 25.10 basis. And I said, look, I don't use this indicator much, but 14 out of the last 15 times it's crossed. It's been bullish. That was at $23.25. And now you can see today it absolutely worked. And now we're at $33.53. So up about, give or take, 50% after that cross. And look where we are in the long-term context. We're just getting started. I mean, this thing, like I said, over the next 3 to 5 years could be 60, could be 70, could be an $80 stock with the amount of growth and demand from millennials, etc. New housing formation, C&I, business recovery, small business starting, they're just perfectly positioned. And then they'll get that asset cap lifted, and that will be another catalyst. So this is very exciting to see play out as well. Okay, so we got that. Next is this is the XLF ETF now starting to break out. If you look here, the last 2 times it broke out was 2012. It broke out after long sideways consolidation, and then it just persisted for another, went from 1097 to 1857. So it went up 80% over the next 2 to 3 years, and then it went sideways for a couple of years, and then right after the election it broke out, and then it just rallied from 18 to 28, so another 50+% over the next year and a half, and now it looks like we're just breaking out again. So if we get a similar type move over the next couple of years, the XLF could be at could be at 45, could be at 50, which means some of these major names like JP Morgan, Wells Fargo, Bank of America could be up a lot further than 50%, which would be exciting to see. This is the Defense and Aerospace ETF, just kind of showing you long-term context. It's not even close to breaking out, and last 2 times it did, from 30 to 58, so it went up 100% on the breakout from 2012 to 2015. Then it broke out again in 2016, and it went from 60 to 120, so again about 100%. We're not even close to the breakout, so if we broke out from 118, it's now at 97, the ITA ETF. Maybe that goes to 200 over the next 5 years. I mean, there is just huge opportunity here as commercial aviation recovers. I mean, again, Wall Street's the only place when they hold a clearance sale, no one shows up to the sale. But that's the opportunity, and that's why you're listening. So hopefully I'm pointing some of this stuff out, and we'll see if it works as well as the energy and banks have so far. Moving right along. Worst stocks are doing the best. Miles Udlin. We've talked about this before. High short interest stocks have outperformed low short interest stocks since the announcement of the vaccine. So it's something to keep an eye on. And the reason is because there's some speculation, obviously, and there's some froth, obviously. And I got to be honest, when I'm looking at the stocks on a daily basis, and I go through basically every large cap stock every single day just to get a feel for the market, what I'm seeing is what's oversold and ready to bounce are utilities, staples, and healthcare and pharmaceutical and drugs, which tells me what's trading down is defensive, not defense and aero, defensive groups, utilities, staples, and healthcare. And if they bounce, it means that the general market is probably, at that point going to take a breather, which means either sideways grind or rotation. So you can see utilities, this is bullish percent. This is really subdued. It's at 35%. Utilities are really down. Actually, this should have... There we go. Okay, so that's the utilities chart behind the bullish percent. Usually you bounce from these type of levels, and if utilities are bouncing, those high-risk speculative stocks are probably going to take a little breather. Same thing with staples, are very defensive. You can see that they've been subdued here since the beginning of the year because risk has been on. If they bounce from these levels, which they have a tendency to do so, that means the market's going sideways or breathing. Same thing with healthcare. And I'm seeing a lot of the big pharma companies want to, are oversold and want to bounce here. So just something to keep an eye on that those start to bounce and there might be some risk. The theme this year, I think, is going to be rallies under the surface, which we've talked a lot about in recent podcasts. This was an interesting article in the Financial Times today by Marin Somerset Webb. Is the party over for top tech stocks? Look, that's not something you ever want to call. I've been calling for relative outperformance from the cyclicals, not zero sum. But she makes a really compelling argument. And what she says is that, she makes all the arguments that FANG is 24% of the index, yada, yada. We've heard all that. This paragraph here, investors also haven't exactly been complaining, obviously, that they've done well. However, now might be the time to take stock. If you're a global investor, do you want to be 60% in the US and 15% in 6 tech companies? One way to answer this might be to look at what happened to the top dogs of the past decades. The closest comparison is probably 1970, when, according to data from Schroders, the top 5 stocks in terms of market capitalization were IBM, AT&T, General Motors, Eastman Kodak, and Exxon. They made up 24% of the S&P 500 index. By 1980, 4 were hanging on. Kodak had been replaced by Amoco, but the new top 5 were only 17% of the index. By 1990, the top 5 were just 13% of the index, with only IBM and AT&T still present. By 2010, the share was down to 11%, and all of the original 5 were long gone. But then big tech really took off, and now the top 5 came to dominate the market. Today, they account for 22% of the index and have provided pretty much all the outperformance of the past few years. Take them out of the numbers, and both emerging markets and Japan outperformed the U.S. last year. So could the 2020s really be the decade of no disruption? The one when the top dogs are so brilliant beyond that they stay the top dogs? That seems unlikely. Look at the valuations. We've all got rather used to the idea that, driven by its brilliant tech stocks, the U.S. market trades at a premium, and that having been the world's best performing market for 8 of the past 10 years, it somehow deserves to keep winning. And we're seeing indications of that already. If you look at emerging markets, which we've been pounding the table on for 6 months, small caps, and ex-U.S., they are trading at a discount. So she says the gap in valuations between the U.S. and the rest of the world is now higher than it's ever been. The current cyclically adjusted price to earnings ratio for the U.S. I hate the CAPE ratio, but I'll read it anyway. U.S. is 35 times against 21 times for Europe and 14 times for the U.K., for example. There's a lot of opportunity embedded in U.K. By the way, there was an article in Barron's this week. For it to fall to historical norms, says Schroders' Duncan Lamont, could mean the U.S. underperforming by 5% a year for a decade. That said, valuations clearly tell you little about what's going to happen in the markets in the short term. What might make a difference and trigger a change in sentiment? Vaccinations are the obvious factor. As the world emerges from its various lockdowns and economic activity, stocks in cyclical companies will benefit. Okay, she's singing from the same hymnal. They aren't hugely represented in the U.S. They make up about 35% of the market against more than 55% in the U.K. and Japan. So, the return of physical freedom in the West will therefore help non-U.S. markets a lot more than tech-heavy U.S. markets. But it's also going to help. So it's a factor issue, not a geographic issue. It just happens to be the case that we're underweight cyclicals in our indices relative to UK and Japan, because these are all multinational companies of these market caps, whether they're based in Japan, UK, US. So they just have a higher weighting to cyclicals because they don't have tech dominators like we do. So that factor is what she's saying. So if you own the cyclicals in the US, you're still going to get that benefit because they're going to gain weight in the index, while the overweight big names, FANG, are going to lose weighting over time, is the case that she's making, which we agree with. and these groups will relatively outperform. So the lifting of the political fog in the U.S. might do the same. Blah blah blah, and that's that. And then she talks about taxing, all the headwinds for the big tech companies that could slow them down. One thing we have surely been reminded of in the pandemic is that when push comes to shove, it's the states that are sovereign. Who would have thought a year ago that modern democratic countries could and would hold their citizens, not just within their borders, but inside their homes? That's power. And if they can do this with impunity, what's a windfall tax on the beneficiaries of the pandemic or regulation that bashes social media? Note the confidence with which Australia has taken on Google, which, by the way, has forced them to pay now media publishers. Now Google's saying they might pull out of Australia altogether, with its demand that tech giants start paying local news outlets for linking to their stories. A key point in all this is that there's no such thing as passive investing. Invest in a global ETF, and you've made the active decision to tie your financial future to the U.S. and hence to big tech. That might be fine, maybe if that's what you want. But if you don't stop to think about the asset allocation inside what you think is a passive strategy, you may find you enter 2030 not as happy a hodler as you might like. This is a brilliant article. I've never read her stuff. Marin Somerset Webb over at the Financial Times. This is really awesome analysis. Check it out. The title is the party over for top tech stocks? So again, keep your eye on Apple for a multitude of reasons, answering Ben's question. Here's Klobuchar, Amy Klobuchar, senator Democrat from Minnesota. She's heading the antitrust push. And here's an op-ed from Jan Rybnisek at CNBC. Recent antitrust proposals could throw a sand in the gears of the economic recovery by stalling M&A. So the first part Klobuchar is saying is that we have to have more power, so they can't do these acquisitions to gain share and push people out, which she's getting steam behind her on. And the second thing is, here's from Fast Company, Amy Klobuchar. Great, breaking up Facebook has to be on the table. So, the guns are out. We know this. There are cases all over the country, federal and state level, against most of the FANGs. That's not going to stop. Moving right along. Inhalable remdesivir at contacts or early onset could generate large growth for remdesivir. That's Gilead's drug. That's injectable now, but I've been talking about inhalables coming. Still in early stages of investigation. But that's a positive note. CVS and Walgreens are now started today getting vaccines for distribution, so that's going to crank up the distribution of that. And then to our article of the week, which is the Bob Dylan knocking on heaven's door stock market and sentiment results. It certainly feels that way. There are pockets of froth and euphoria. There's no question about that. But there's also great opportunity you got to look under the hood for the opportunity. And we recapped what we said on January 21st and last week, which was basically the market can correct in time or price, grind sideways. We got a 3.7% pullback. Whether we get more is unknown, but the opportunity is going to be to use any weakness that does come our way. Hopefully, if you're a longer-term investment, you're praying that we get some weakness here, to add to value in cyclical names that are going to outperform over the next few years. But don't wait for a perfect crash, because, we've got now $10 trillion of fiscal and monetary policy to solve a $750 billion problem. So basically half of a year's of GDP thrown at, including the $1.9 trillion that's coming, by the way. We lost 3.5% of GDP last year, which is about $750 billion, and we got $10 trillion. And the reason that asset prices aren't even more inflated than they've already started to inflate is because we're just getting the vaccinations out. Wait till everyone goes back to their normal. This is going to be a bonanza. I was talking in June, if you remember, about 5 to 6% GDP. Everyone was laughing at me. I remember someone tweeted, "Yeah, I'll make a note of that." And now people are calling for 6 and 7%, and we're not even like a tenth of the way into the vaccinations with people getting back on. I mean, the plane was full on the way down and way back. I mean, that's anecdotal, but people are fine with it. They put their mask on. They go about their lives. Okay, so while there are clear pockets of, so I said last week, while there are clear pockets of froth and exuberance, it is not the case for the entire market as a whole. we will dissect the risk and opportunities below. So I covered the Liz Clayman countdown. I covered that. You know, what do Mick Mulvaney, Colin Kaepernick, and Paul Ryan have in common? They're raising SPACs. In any normal market, when raising money, the simple question anyone asks is, show me your track record. If you're raising money for a fund, you're sending your performance. If you're raising money for a business, you show how you did for your investors in the past. And in today's market, it's become, oh yeah, I've heard of him or her, I'm in. That's kind of what we're seeing in the SPAC market, and that's never a good sign. Many SPACs won't get a deal done, and even worse, the incentives are to get a deal done or they have to give the money back. So you're going to see a lot of crappy deals at super high prices jammed into these just to get a deal, and they'll collapse. That's coming, so just keep an eye out over the next year, and only go with high quality operators that have a track record that could be tremendously successful SPACs. No question about it, but the vast majority are not going to be anything to write home about. So how do we know whether there's a bubble or not? I think it's similar to the quote I had in January 26 when in Reuters, when GameStop was ripping, I said, will it end badly? Sure. We just don't know when. I think the same is true with certain IPOs trading at 30 and 40 times sales, certain SPACs, and certain penny stock pumps that we're seeing right now, but we just don't know when. In the meantime, while stock correlation tends to drop before correction, which is what we were using it for to point out in 2 weeks ago before it dropped 3.7%, it's also a time when stock pickers outperform. So when everything's moving in the same correlation, that's when passive indexers outperform. And when the correlations drop, that's when you can make a fortune. The billionaires who made money in the market buying weakness and selling strength, and that will always work over time. There's been an aberration, in the past 10 years that will get worked away. There've been other times where there's been aberrations, but the Gabellis, the Coopermans, the Buffetts, the Icons, they made a fortune in the 70s when the market went nowhere because there were monster rallies under the surface. And that's the same type of environment. When correlations are low, you can make a fortune regardless of what the indices do. And that's what's happening right now. So don't worry about, are we going to get a 5% pullback or a 3% pullback or a 7%? Who cares? The bottom line is there's a tidal wave of liquidity. You're not going to get that much of a correction, but under the surface you can get big meaningful corrections like we're seeing in defense and aerospace right now, where there's huge buying opportunities, like we saw in banks and energy 4, 5, 6 months ago, and we'll probably be seeing in utilities at some point. They get so cheap, and staples get so cheap that you want to start, in some healthcare, that you want to start to pick those up. And that's the beauty when the correlations are running low. The last time that it dropped like this, it was a similar situation. Right after the election in 2016, you had a drop just like this, and that's started a 1.5-year rally where you never saw more than a 3 to 4% pullback all year, and you saw about 4 or 5 of those. So you had a huge crash in early 2016 in the S&P 500, just as we had a huge crash in early 2020. Then you had the election at the end of the year, just like we had. You had huge weakness into the election, and then you basically went straight up for the next 14 or 15 months, and you had about 4 or 5 mini pullbacks of 3 to 4%, but nothing more. It just grinded sideways, and the old saying and cliche, never short a dull market, is holding true so far right now. So that's something to keep in mind. Ryan Dietrich was on CNBC this morning around 6 a.m. and he said, statistically since I love these cute statistics. I mean, you don't bet the ranch on them, but they're good to hear. Anyway, if the market's up 4% by Valentine's, the market's up 90% of the time for the rest of the year, and the average from being up from Valentine's Day forward is another 13%. So, it could be exactly like 2017. It never is exactly the same. It rhymes, but a lot of the conditions are similar. In the case of 2017, what was the market anticipating? That it went up and up and up and up. It was anticipating the tax cuts that came in early 2018, and then when you got it, it was sell the news, and the market sold off. What are they anticipating now? They're anticipating a return to normalcy and everyone being vaccinated and getting to herd immunity and cases go back down to zero. And that's probably a back half of the year thing when commercial aviation takes off. And, and then you'll probably get a real correction sometime early next year or maybe late this year. Who knows? But it's following a very, very similar roadmap, and it's worth noting. Doesn't mean it's guaranteed to follow, but it does mean pay attention. The other thing that's eerily similar is the VIX. So you had that first crash early in the year, huge pop in the VIX, and then at the election you had another pop in the VIX, and then it just trended down all of 2017. Well, it's following the exact same pattern. Huge pop for the crash earlier in 2020, huge pop in the VIX for the election, and then it's just trending. You just get these little pops up, but it trends down over time, and the market trends up with nothing more than a 3 to 4% pullback every few weeks. Scares people. This is the big one. This is the big one, and it keeps grinding higher, never short a dull market. So something to keep in mind. But under the surface, there will be huge crashes of different sectors that you can buy on the cheap, and there'll be huge rallies even if the general indices are going sideways. And by the way, for the general indices to go sideways, you need the big weights to be somewhat subdued, and that's why my eye is on Apple. If Apple stays flat to sideways to down, then the general indices are going to be more subdued, and those cyclicals can really start to rip as more and more people get vaccinated. So the other point that I'm making here is with regard to rallies under the surface, when you hear talk that we're in a bubble, walk through these stocks and below and ask yourself, are these stocks in a bubble? And, there's a lot of cyclicals in here. Range Resources, there's a natural gas producer. Sure, it's up 100% off the bottom plus, but it's still got huge upside. This was an $80 stock in the last commodity cycle, $80, $90 stock. So there are just immense opportunities here. Occidental, look, it's up 100%, over 150% in the last couple of months, but it's still down, 75+%. There are great opportunities. Yes, there's dilution, but as the cash flows come in, they'll buy that stock back. It's just the same thing every cycle. So, EOG. Okay, so here's PCG, a utility. Huge guys have positions. I think Third Point has a huge position in this. Seth Klarman, Baupost. This thing came out of bankruptcy. It's trading at $12 a share. It's down from $70. So, there are great Fox A, which I talked about, Fox Corporation. You get a great growing network with Tubi streaming. You get the online betting for free. It's trading at 13.5 times. It's well run. All the noise and nonsense around the election is behind it. Advertisers are going to come back. These are great opportunities in my view. These are opinions. Kinder Morgan. Rich Kinder has been buying his stock at higher levels for the last 5 years. The guy's not an idiot, and this thing is going to be back up before we know it. Con Edison is another utility that's down quite a bit. More energy. Exxon, huge run here. Up 75, 80%, but it's still down. It's got huge recovery potential. Enterprise Transfer, there was a monster options position, unusual options position. Citi, it looks like it's had this huge run. It's got so much to go. The defense stocks, L3 Harris Technologies, General Dynamics, these things are still huge. Lockheed Martin, another utility here, American Airlines. Look, not all of these are going to be great businesses. They're down for a reason. We know that. Teva, they all have their reasons. They all have their hairs. Boeing. But if you do your homework and you have a basket of them, one or two don't work, the others double and triple over the next few years. That's how you build wealth. It's that simple. So that's that. Moving on. I put together like 30 or 40 of the indicators we look at on a regular basis. Most of them are near the top end of their range, meaning, market's getting a little, the risk reward is less favorable than when they're on the other side of the spectrum, is what I should say. But if you pull sector by sector, again, rallies under the surface, there's opportunity. For those of you on the podcast, we're going to get cut off in 2 minutes. Just go to hedgefundtips.com. Click on the VideoCast. It's a YouTube video. You can just fast forward to minute 60. It's word for word the same thing, and watch the last 5 or 10 minutes so you don't miss anything important. Okay, now, if we do get a pullback, where would we be looking? We'd be looking, mind the gaps, okay? So there are a couple gaps that we've taken in the last few weeks after we had the huge degrossing, and then people had to play catch up to panic back into the market, which, by the way, the National Association of Active Investment Managers, in my article, which I write on Wednesday night, was at 79%. That jumped to, I think, 110%. So they all chased back in a major way over the last few days, and now they are at an extreme as well as the retail people with the bullish percent. So they're back up to 110% equity exposure, the active investment managers. So if we get a pullback in the next few weeks, some targets, again, these are going to be, I think they're going to be subdued. Like, we'll get multiple 3 to 4% pullbacks throughout the year. Here at 38, whatever it is, 75, there's a gap that could be filled at 37.80 if you get a more pronounced pullback of 4%. Something to keep in mind. But the key is, with all that and any pullbacks and all the little froth, etc., don't fight the richest guy in the world. And I'm not talking about Elon Musk. I'm talking about Jay Powell. Musk plays with billions. Powell plays with trillions. We've got money supply up 26% year on year. Look at the pretty picture. You've got the Fed balance sheet at $7.4 trillion and going higher. You do not want to fight that. You've got earnings estimates going up every single week, better than expected, and that increased again this week. It's now at $173.96 for 2021 and $200 for 2022. So 4,000 on the S&P is trading at 20 times next year earnings with rates at basically zero. It's not bananas. It's higher, but not relative to rates, and not relative to the fact that these earnings are probably still too low. So the amount of reserves that financials have not yet released, and they're going to be a major factor moving forward. Cases are rolling over. They look exactly like the GameStop chart, spike, fall, spike, and then just roll over permanently. And I think that, I don't know, GameStop probably won't go to zero. I think there is something to GameStop, probably. I don't know what it's worth. I have no idea, to be honest with you, but $15, it's not worth $4. It's 15, 30, I don't know, maybe 40 or 50 from the Chewy guy excitement. It ain't worth 483, I'll tell you that right now. So so that's what's going to happen to cases. That's extremely bullish. Vaccines are going through the roof. 33, it's probably 35 million today. 2 days later, cases are coming down. The AAII sentiment, we're at an extreme 45% bullish for the retail investors this week, 26% bearish. That is an extreme. So again, I'm less interested in the general indices. I'm more interested in the opportunity under the surface, and it's there. Fear and greed's in the mid-60s. That's neutral. The active managers did shoot up from 79 to 110. I'm looking at on the newly revised chart. Our message for the week will continue to add to defense and aerospace on any weakness on the second half commercial aviation recovery thesis, and hold banks and energy as we have a much lower basis in these groups. And so do many of you who've been with me for a while listening to this podcast VideoCast. Some unusual activity. This was Jerry Jones natural gas. Someone came in and bought 1,000 contracts. You don't see a lot in these small stocks, so that was kind of unusual to me. Wells Fargo today, huge buyer, 34,000 contracts of the May 37.50 call strike options. So that's just a few months out. That is a big buy. That's enough to control 3.4 million shares at $37, about $100 million of stock. More than that, 120, give or take. General Electric, monster buy, 72,000 contracts today of the 20 call in June. So they expect the stock to basically go up 80% over the next 4 months. Probably a little ambitious, but that's some big money. That's enough to buy 7 7.2 million shares at 20. So $140 million of stock. That wasn't, that wasn't your aunt by making that purchase. That was some fund or institution in the market, and those are big numbers. As far as the economic data, consumer sentiment came in a little bit light for this read. That'll probably recover now with the reopen, but keep an eye on Michigan consumer sentiment, and expectations were a little lower. It could be related to just uncertainty about new policy and that type of thing, and that should get ironed out. Continuing claims missed, jobless claims missed. That's from regional shutdowns. Hopefully that will get worked out in coming weeks. But this could be, the kind of stuff that causes the market to take another 3% breather at some point. Crude draw, 6.6 million barrels draw. Again, we put out that Rystad chart in June. We said this would be happening. It's happened basically every single week except for 2 ever since. And the price has doubled. So I hope you were able to take advantage of that. JOLTS, the job openings were beat expectations, so 6.6 million jobs. Problem is now private employers are going to have to compete with the federal government. As I said last week, the enhanced unemployment is going up from 300 to 400. It's being extended from March till September. So the run rate between state and local can be as high as $800 a week. That's give or take a $40,000 a year run rate. That's a lot of money to compete with for entry-level jobs for businesses that have had limited revenue over the last year to pay up to attract those people away from the government pay. So they got to pay more than the government to get these people incentivized to come back to work, and it's going to be a hard thing. And this wage inflation is one of the key tenets that I've said why this inflation that the Fed expects to be transitory is not going to be transitory, because wages are sticky. And then you've got the commodities now with supply being taken off from federal drilling. So inflation's coming. But it's nice to see the job openings. That's good news. The bad news is people aren't taking them because the incentives aren't currently there. Eventually, employers will get so desperate with demand that they'll just pay whatever they have to get a warm body. But we're not quite there yet, and that'll be a good thing for people. They'll make a lot more money, and that's a good thing. So, and then this is the earnings estimates continue to go up. By the way, I talked about a number of weeks ago that estimates were too negative. Well, they certainly were. Negative 9.7% just at December 31st was the estimate for Q4 earnings. I said they'd be positive. They're now 2.9% positive, and that is with 74% of the companies reporting 80% beat rate on the bottom line, 78% on the top line, and year on year in the middle of a pandemic, Q4 2020, beat earnings were up 2.9% year on year. So this is really some good stuff to see, and continued good things moving forward. So with that said, thanks for tuning in. I know we covered a lot. Hope you found it helpful. We'll be back next week, same time, same place. Have a great extended weekend. Talk to you soon.